Hey, this is Jim Cunningham. We're going to talk about protecting your wealth and getting your A team together. We're not talking about the 80s show. So, if you've got significant income, wealth, own a business, you really should consider assembling really a team of experts, if you will. And this is your A team. We're going to talk about what that means, what it isn't. It's not the TV show. Sorry. But this really optimizes tax efficiency, return of investment, I guess you could also say, and protecting what you have for those that you love, your family, your friends, whatever it is. If you're watching this on YouTube, please click and subscribe, and this will pop up in your feed. These are released about every Thursday at about 6 p.m. or so. And if you click the bell, it'll also alert you. And we do those weekly on Thursday. I'm Jim Cunningham. I'm a partner at Cunningham Legal. I have over 25 years experience as a lawyer. We have offices throughout California. I am a certified specialist in estate planning, trust, and probate law, also a real estate broker, securities and insurance licensed, and a pilot. Although I'm not current, I'm a third generation pilot and a second generation lawyer. This is our great team of lawyers. I've got two partners, Rochelle and Tasha, and just a great team of people. And we're really client focused. And we're really, we view ourselves as in the care business. We're here to care for our clients. Right. We're not out suing people or chasing ambulances or, helping people divorce or all that other stuff. We are helping preserve wealth for the next generation. And we're here to care for our clients. So this is a disclaimer. I'm a lawyer. I'm talking. This is not legal advice. When I say you, I don't mean you. I mean, not you particularly, but you as a quick way of saying who I'm talking about. But this is very important. And really, this is serious. Don't watch this and go out and do a bunch of stuff and say, well, I'm doing this because Jim said to do it. Really bad idea. So what is an A team and why might I need one, or why might you need one? Well, which A team are we talking about here? We're not talking about the TV show from the 80s. I loved that show as a kid, but unfortunately, we're not talking about that A team today. We're talking about what amounts to a troika, this group of three. Typically, it's the CPA, certified financial planner, and the estate planning attorney. Those are the three people that are that form the core. Now, there are some other advisors we'll talk about, but this really does form the core of the team. And these are the people that really are your trusted advisors if you're looking at this. So I think about the most important decisions in life are who. It's not how and when or whether, but think about it. Who you marry is a pretty big decision. Who your friends are, right? Especially when you're younger, even when you're older. Right? Your friends can get you into trouble, or they can really, set an example for you to follow. And really, who are your advisors? I mean, these who decisions are really, really important. And you really need to ask yourself, who is on your A team right now? Because you already have an A team. Now, it might be an A team of one. It might be you. You might do your own taxes and, think you're doing your own financial planning and kind of, doing all the stuff yourself, or maybe you're not doing anything, right? But think about the people on your A team. If you already have a lawyer or a CPA or financial advisor, you might think, you know what, they're not really doing the job I need to do. I do need to say this, though. If you're represented by a lawyer, I'm not soliciting you as a client, because that is unethical under California state bar rules. But, you may be thinking to yourself, this person I've kind of outgrown. Also, sometimes the advisors, and we really see this with CPAs many times, if you're the wealthiest or the highest income earning client in your CPA's practice, that CPA might tell you, you might need to go to somebody else, right? Because as we go through this, you'll see that there are differences among professionals and different skill sets. So different people need to have different needs. And so there are these classes of need, really, we can talk about. So if you're looking at this or you're listening to me, you can think, all right, Jim, well, what are the examples of different kinds of people? And these are the ones really we see in practice, kind of in the frequency. High net worth families, that's very much a core of our business. What's high net worth? I mean, it means different things to different people, but these are people with some assets that their assets will outlive them, meaning that when they pass away, they're going to have something left. And you could just really generally throw that into a high net worth bucket. Some practitioners will say, oh, it's $1 million or it's 10 million, or there's some minimum. We don't really follow the minimums because you have this correlation between net worth and income. And that's really where we can add value as a firm. But you have high net worth families, you have portfolio income. So this would be somebody who's got investments, and they have income from those investments. And I'm painting a very broad picture here. And many times those people are looking to mitigate taxes and, quite frankly, mitigate fees. And that's something that I think professionals probably don't talk enough about, is how people charge. And we'll talk about that a little bit later. Business owners, with a business, and then the business owner exiting the business. If you're a business owner, one day you will exit that business, right? It's either going to be on your terms or, somebody else's terms, I suppose. But we don't live forever. So, death is one of the consequences of living, that it does end, and you will exit your business, right? The question is, should you plan ahead to exit your business? I would say yes. And we've covered this in other videos on our website, our YouTube channel. I would encourage you to take a look at that. High W-2 earners, this is really especially true, certainly where we are in California, in the Los Angeles and Bay Area markets. You really do have people who have a tremendous W-2 earnings, and the W-2 people really just get kind of screwed on taxes, for lack of a better term, right? You really are limited on your deductions. Those have been kind of going away year over year. If you're exercising stock options, many times the only thing you can do is exercise the option, pay the tax, and now you have the cash. So if that's you, it's a good problem to have, but frankly, it's still a problem. Real estate investors and preserving Prop 13. This is really important. So for those of you who don't know what Prop 13 is, you can hit the snooze button, I guess. But if you're a real estate investor, you know what Prop 13 is. It is California's property tax system that essentially means that the longer you hold property, the lower your property taxes are when you look at the market value of the property. And I'm speaking very broadly. So for many of our clients, they would not continue to own those properties if those properties were reassessed at their current fair market value. These are some of the things the A-Team helps with. And you can see these are different, right? Non-U.S. citizen taxpayers is another one. If you are a resident alien in the United States, a green card holder, and you're a taxpayer, you have some special issues that need some special care. Professionals, I would say that, doctors, lawyers, CPAs, financial advisors, architects, those in the professions do have special tax needs, and we can really help those people, but that's a different set of need. Professional athletes is another one. Many times professional athletes will play in multiple states and countries, and their tax returns are about this thick. And if you're a professional athlete, you know about getting a good team together, right? You have your team of advisors, and those are a little bit different than maybe someone that's a high net worth family or business owner. People with disabilities, I put this, this does not necessarily correlate with wealth, but really, if you have a loved one with special needs and you're worried about what happens to that person when something happens to you, you need an A-Team, right? And this may not be money. This may be caring for the person, making sure that the person you love has a fruitful and healthy and long life, right? That has personal success. And when you're not there to help that person. And then lotto winners. And if you're a lotto winner, I put these, we don't get a lot of them, but those lotto winnings are getting pretty big. So examples of what an A-Team does. So what does an A-Team do? What sort of activities? Well, planning for income distribution of wealth versus accumulation. So what am I talking about? If you're in a position where you say, I've worked hard my whole life and here it is, I'm 60, I'm retiring, I'm quitting work. You're not going to create any more wealth. Many people, when they quit work, in that sense, the wealth creation kind of stops, right? Because your income stops. Now, you could think of some other situations where that might not be the case, but in general, it's a shift in mindset. It's almost like, you're climbing the top of the mountain, and then you're at the top of the mountain, and now you need to go down the mountain to get to your destination. And that requires a different skill set. All right. Sometimes, as you know, if you're a hiker, sometimes going down a mountain can be more dangerous than going up the mountain, right? So that sort of planning for wealth distribution in retirement years or in post-work years is something that our A-Team really helps many of our clients with. Strategies to preserve Prop 13 taxes. This is a very complicated area. This is a slow simmering, but very important area. What I mean by that is Prop 13 has been around since 1978. And so we're in 2023, however many years that is. The value of Prop 13 is slowly, incrementally getting more and more valuable. People want to keep that. So if you have a real estate portfolio and your property's reassessed, if you look at that, you go, wow. And it might not even be you doing anything. You know, if you're stuck in an LLC with somebody and something happens, that whole property might get reassessed. Who's going to pay the higher tax, right? So you want to preserve that Prop 13, and there's a lot that you can do to preserve it, but it really does take this sort of A team of advisors. And I was talking to an attorney yesterday who said, you know, he's a real estate attorney, and he says we come up with this great real estate plan, and then we talk to the tax lawyer, and the tax lawyer says you can't do that, right? So this is another thing, is that there are different, and we'll talk about this, there are different lawyers. So when you hear the term lawyer or attorney, you might think, they're all the same. No, this is a highly specialized field, in the sense that, you know, if you're an MD, if you're a doctor, if you're a physician, that is a hyper specialized field, right? It's the same with law. So it's really no different than medicine. Uh, Real estate cash flow analysis. This is really important. If you look at many people who have held real estate for a long time, this real estate, they've fully depreciated the real estate, and, you know, the maintenance is starting to creep up. And that's where you start looking at, what is the return I'm getting on this particular parcel of property? And so many people look at alternatives to get your cash flow up. And it may be exchanging property. We have some good content on 1031 exchanges on our YouTube page, and maybe a lot of things. But again, you can see the role of the A team. You get a bunch of smart people in the room, and they figure this out, right? Okay, what are your goals? How are we going to get there? It's leveraging your mind, so you're not trying to figure this out on your own. Gifting and charitable strategies. Many of our wealthy clients, you know, you can give $17,000 per person per year. So if you have 10 kids, you can give 170,000. If your spouse and you have 10 kids, your spouse can give another 170,000. So it can really be a meaningful difference. Many times we wrap that in a trust structure, or sometimes people just give their kids the check. You know, here you go, Happy New Year, here's your check. Charitable strategies, primarily tax deferral strategies, and also helping out charities. But the charitable trust is a very powerful vehicle to defer taxes, meaning if you're going to get a lump of money, let's say you're going to get $1 million in a year, you're going to pay a tax at a really high rate. It might be better to spread that $1 million out over a 10-year period. And you can do that on a charitable chassis and spread that income out over a period of time. Again, we have more material on our YouTube page on that. Roth conversions with tax offset strategies. So this is what is called the backdoor Roth conversion. So many people, they built up a really big IRA or 401k. Remember, when you put those dollars in, you get a tax benefit, but those cows come home, right? Those chickens come home to roost, whatever you want to call it. When you pull that money out, you got to pay tax on it. And this is where we look at economic modeling. And this is where we look at sort of forecasting. Does it make sense or not to convert all or part of your IRA to a Roth IRA where it's not taxable? It may make sense. It may not make sense. And we've got an example here that we'll cover. Planning before retirement, inheritance, or sale of a business. This is really important. So this is if, you know, I don't want to get too down in the weeds, but I will tell you, depending on certain circumstances, when a person passes away or when a person exits a business, the taxes can be over 50%. They can be 80%, especially on an IRA. So these taxes can be crazy high. And if you don't have planning, all this blood, sweat, and tears that you spent building your IRA or whatever it is ends up going in taxes. Most people don't want that. And then also debt structure and analysis. And this includes mortgages. Now, I know we're in kind of a higher mortgage rate environment, but many of our clients have notes that do come due, maybe in 5 years, maybe they're 7-year terms if it's on commercial property. So these are things that we're looking at with clients, and debt structuring and finance. And that's a very important, almost like a CFO level, a chief financial officer level analysis. And for some clients, this is very valuable because you can really save quite a lot of money. So the A team consists of the CPA tax advisor, certified financial planner, and estate planning attorney. Those are what we call the core advisors. Now, what do I mean by core advisors? Well, what do I mean is that, remember the slide where we talked about, oh, you might be a business owner, you might be a high W-2 earner, you might be a real estate investor. All of those people are going to have the CPA, financial advisor, and attorney on that A team, right? Then we have these ancillary advisors. And sometimes these people, they pinch hit. They might come in for a reason. They might come in for a season. They might come in for life, right? For the life of the A team. And it really does depend. So I would say that lawyers, again, I mentioned that lawyers aren't all the same. They're different lawyers for different subspecialties. And the big ones that sort of the big subspecialties: tax, corporate, real estate, labor, M&A, which is mergers and acquisitions. Many times these lawyers are working together. They may be in different firms. They may not even be in the same firm. Sometimes they should be in a different firm. Maybe corporate counsel is a different firm than your own personal counsel. But these lawyers should be able to work collaboratively as a team. And they do. In the real world, lawyers do actually work with other lawyers in a collaborative manner. It does exist. The real estate professional, broker, real estate agent, whatever it might be. Sometimes that real estate professional is involved in transactions. And I would lump into that bucket also the 1031 accommodator. So that's the person that might come to the party. If you're doing a reverse 1031 exchange, and we cover that in one of our videos, where you buy your replacement property first, which really helps, can help out a lot, right? If you buy that property first, that's a little bit more complex transaction. That's something you really need your knowledgeable 1031 accommodator in on. Mortgage professional, obviously somebody who's knowledgeable with mortgages and rates and different products and offerings. Valuation experts, that's very, very important, right? Many times you might be buying out a partner. You might be making a gift to children. You might be selling your business and you need a valuation. So those people tend to come in for a particular reason, or sometimes a season, but typically more for a reason. And then your C-suite employees, meaning your leadership team. If you're a business owner and you have a leadership team, those people oftentimes come in because frankly, they have the substantive knowledge many of the times. And I'm talking like the CFO, sometimes a controller. A lot of these people have substantive knowledge on the financial aspect of it. So very, very valuable. We've got a question here. Anita asks, Jim, when someone plans an A-team meeting, does that person pay each leg of the team, or how does that work? Yeah, we'll talk about that. Great question. So next is, how do you create an A-team? How do you do it? Well, you can have the instant A-team. Just add money, right? Kind of like instant breakfast. Just add milk. My parents gave me instant breakfast for breakfast when I was a kid. I'm a kid of the 70s. Just reach out to us and we can set you up with an A-team. That's probably the quickest way to do it, the easiest way to do it. But you might have your advisors already. You might just need components of the A-team. And a lot of our clients are struggling now trying to find a CPA. Many CPAs are retiring. And if you're filing a 1040, an individual tax return, and you're a W-2 earner, it's kind of hard to find someone to do that tax prep for you. So instant A-team. If you're more of a do-it-yourself and you're like, well, I kind of want to create my own team, you need to figure out your needs. But here's the thing: you don't know what you don't know. And self-study is important. Watching these videos is great. And when it comes time to actually figuring out what you need to do, like what are the things I need to be looking at, you really do need somebody who's knowledgeable, who can sort of see what might be missing. And really, that's one of the hallmarks of an expert is an expert can look at something and say, yeah, I see what you have there, but this is what you're missing. It's a little bit easier to figure out what's right and what's wrong if it's there, but that missing element often takes an expert to discern that. So determine your needs and find competent professionals who are available. And this is really critical, who are available. It's a different world we live in now, and many people are retiring. And a lot of what we're talking about, these tend to be people who are more seasoned, older people who have been working in these fields for a much longer time, and they have a different perspective and knowledge base. And so a lot of these people are just busy, quite frankly. And then make them work together. Now, I will use the term make them work together because there is a reticence among professionals, typically lawyers, right? Oftentimes lawyers think they're the smartest person in the room. There's a reticence to work together. And this is where they need to overcome this reticence, your A-team does, and they need to work together because this is in your best interest. And the instant A-team, quite frankly, is much easier. I will say this a little bit of a caution. Some advisors might not stay in their lane. What I mean by that is sticking to what they know and what they're good at. So you might find some professionals dabbling in another lane. You might have a professional who, a CPA who says, oh, you need an LLC. I can set that up for you. Yeah, I mean, you can go online and set up an LLC in California in probably 5 minutes if you know what you're doing. But creating the entity is just the tip of the iceberg. There's a whole bunch of other stuff that goes on with that. And especially if you're involving real estate, you can really step in it and have your property reassessed when you put that property into an LLC. So this is where you really do need an expert. You need to not step in it. And I would say I encourage people, the people we work with, stay in their lane, quite frankly. I mean, we stay in our lane, the CPAs and certified financial planners stay in their lane, and that's very important. So part of it too is you don't know if they're stepping out of their lane, right? That's going to be a tough one as well. So A teams aren't free. So this, Anita, this answers your question. How do attorneys, how much is this? It's crazy. How do I budget for this? By the way, I don't get offended when people ask how much, because if I say, you really need a whiz bang, and they go, what's a whiz bang? And you hear like the Charlie Brown. And the next question is, well, how much is it? What is it and how much it is? Because those are really the only questions you know how to ask. So if you ever ask someone in our firm, that's fine to ask how much, because I get it. It's kind of new and this is all technical. So how do attorneys charge? Well, attorneys charge in one of four ways. They charge by the hour. Now, many times an attorney will require a retainer. And if you hire our firm and it's a more complex matter, it typically is an hourly engagement, and you pay us a retainer and we bill hourly. There's a flat fee. A flat fee is, we will do this limited thing for a flat fee. Those I would say, the attorneys who are doing flat fees, I really see a movement in the legal industry to get away from flat fees. I don't know if the world is becoming more complex or things are just harder post-COVID in this distributed or this hybrid work environment. I have no idea, but it's really hard to gauge how much time something's going to take if there are a lot of people involved. So I see attorneys moving away from flat fees. Hybrid fixed fee. Now that means it's a flat fee, but if it goes over, the hybrid fixed fee would say, okay, this is $5,000, but if it goes over, it converts to an hourly. And that's when the lawyer knows how long it takes the lawyer to do the work. And if it goes over, typically it's because the client the problem is the client, for lack of a better term, is that the client is asking a lot of questions about stuff because they have this need to understand and be frankly educated. And there might also, that the scope of engagement might expand. So you might start with, hey, it's this, but as you go through the engagement, you find that the lawyer's taking on more than they initially than everyone thought the lawyer would be taking on. So that's hybrid fixed fee. It starts out flat, converts to hourly. Contingency is, hey, I'll represent you in this accident case, and I'll get a percentage of the recovery. We don't do contingency in our firm. CPAs charge exactly the same way as attorneys charge. All right, hourly, flat fee. I typically see hourly and flat fee. Contingency, they're not chasing ambulances, but some CPAs might do some tax credit strategies where they charge you a percentage. We did a program on employee retention tax credits last time, and that individual does charge a percentage of what is recovered. So there is a sort of percentage of recovery. And certified financial advisors charge typically a percentage of assets under management, meaning those assets, if they're managing a portfolio of $1 million, they're going to charge you a certain percentage on that $1 million. Commission, if you're buying and selling tax-free bonds, those typically have a commission. If you're doing life insurance, there's a commission. If you're doing an annuity, there's typically a commission. So those are commissionable things. They can also be fee-based as well. And some certified financial planners don't sell you anything. They don't manage any investments. They are purely advisors, and you might pay them an hourly rate. I will say that there's a tax mitigation strategy we'll talk about in an example when it comes to a certified financial planner. So if you've got, if you have a financial advisor and you've got a few $1 million, maybe 5 million is kind of the break even, it might make sense to pay your fees slightly differently. And we'll cover that in a couple of slides that'll save you some tax. So I'm just kind of walking through things that the A team people do. Why would you need an A team? Why? Well, a lot of it has to do with tax and wealth preservation. It's tax efficiency and fee efficiency, because not all lawyers charge the same. Not all lawyers have the same skill set. Same with CPAs and the same with certified financial planners. Most people do want to pay the least tax and fees possible while securing a legacy for their loved ones. And we're here as a law firm to help you craft that plan. So if this is something you're interested in, reach out to us. We'd be happy to talk to you. And we give you options and make recommendations that are part of an integrated plan to reduce the overall tax bill and really, frankly, keep fees down. So we're very mindful of that We'll talk about that in a few slides. And this leads to more wealth for yourself, your family, and your loved ones. So A teams have to strike a balance between value and complexity. So what do I mean by this? You know, one of the things I ask clients in the beginning, the first question I ask is, how do you feel about taxes? Right. And this is a question that your advisor should be asking you. Some people say, the thought of paying taxes makes me want to, like, pull my hair out and poke my eyes out and make me go crazy. Okay. Right. It just, I hate taxes. Other people are like, that person might think you just pay taxes and that's it. And I really don't want to go to a lot of lengths to avoid that. The question is how much juice do you want to squeeze out of the orange, and is the juice worth the squeeze, right? So it's sort of orange juice analogy. As professionals, we have to prioritize a framework that to evaluate each initiative. So if a client comes to us and they say, look, Jim, I'm fine tolerating complexity. That's fine. I want to minimize taxes. That's very helpful for us. Another client might say, I'm just not willing to go that extra, that twice as much work to get 10% more benefit. So why don't you throttle it back and make it a little simpler, a little less complex? And that's the balance, right? So the value, which is the savings, and the cost, which is the total fees, right? The professional fees. And, part of this complexity is headspace. Like, do you want this occupying your head? Some people love it. Other people, they say, I just want to go fishing. I don't want to deal with it, right? And these initiatives are curated by your A team and prioritized and discussed with the client. Many times the A team will meet outside of meeting with the client, and we'll say, okay, well, Bob wanted this. And so based upon that, we're going to make these recommendations and not make these other ones. And we do talk internally. We have those conversations. And really, it's frankly a puzzle, right? And it's a puzzle to optimize a plan that strikes a balance between value and complexity, right? Sort of price, headspace. And it's different for everyone. It's not the same for each person. So let me take a question here. Max asks, for those outside of California, how important is local representation? For example, probably the lawyer, maybe the accountant need to be familiar with local laws and taxes, but the financial advisor may not need to be in your state. Yeah, Max, I would say that's generally true. Many times people from out of state will hire us, and then we will have local counsel. Many of these are federal. When you get into tax stuff, you have these federal benefits. There are state-specific benefits. There are also rules that preclude lawyers from practicing in other states, meaning I'm not licensed in Nevada. I can't go to Nevada and render legal advice, but I can render legal advice if my feet are in California. That's kind of the idea. Anita asks, is there a prudent value or portfolio value where it would be prudent not to utilize or utilize an A team? Yeah, Anita, I mean, again, this stuff isn't free. When you hire lawyers and CPAs and financial advisors, there's a cost associated with that. But again, it depends. I had a client years ago, had a $50,000 estate and a child with special needs. And she wanted some pretty complex planning because that was all she had. And that was, her only child. And it was worth it to her. So really, I think it's is it worth it to you? So these are some red flags and some overlooked opportunities. I'm just going to kind of riff here for a little bit. On the investment strategy, there's something called a proprietary fund. And what a proprietary fund means is your XYZ, big bank, big institution. You might be a big bank, and you might have a financial advisory firm that the bank also owns. And they say, hey, why don't you buy this XYZ bank fund? This is a great fund. Well, they're making money 19 ways to Sunday. Those proprietary funds, again, that's a red flag. I'm not saying don't do it, but it's a red flag. You really need to take a look at that. And some professional or some financial advisors are captive in the sense that they have to offer one thing or another. They're not independent. And many times your return is less, your fees are more. And I'm not criticizing anyone. I'm just telling you, this is just a fact. Okay. I would say appropriate risk in taxable versus tax deferred accounts, meaning you might have a different strategy on those. So if your tax deferred account, if you're not going to take that money out until age 75, which is a new minimum distribution rule will be in the future, you might have a different investment strategy than the money you're going to be using until age 75, right? So this is a little bit of a nuance. And many times we don't see that. It's like, we'll just kind of put it all in there, lump it all in there. And you may want to have, Your municipal bonds, which are if you buy California bond as a California resident, you're not paying state, local, or federal income tax. A big mistake we see is a municipal bond in an IRA. Like there's no reason for it to be in an IRA because it's tax-free. You would want to have that on your own personal, in your name, and have your non-muni bond assets in the IRA. And again, I'm not giving financial advice. I'm just saying these are some red flags that we see. And then there's something about risk-adjusted return, meaning to a pretty, not a mathematical certainty, but a very good estimate. You can look at the volatility of a stock. You can look at how much it goes up and how much it goes down and what the return is. And sometimes there are other investments that have less volatility, but the same return. And that's what we're talking about is a risk-adjusted return. Basically, you're going to get the same return without risk. This is like pure math stuff, but these are things that really an A team can help. And obviously this is the certified financial planner that's looking at this. Tax planning, not considering income in respect of a decedent. That is what IRD is when evaluating estate taxation. What am I talking about? If your IRA is left to your estate, if your IRA is left to your trust, in many instances, all that money comes out in 1 year. That is called income in respect of a decedent. That means you pay income tax on it. If you have $1 million IRA and you have to pay income tax in 1 year, that's going to be over 50%. And that kind of stinks, right? You need to pay attention to that. That's a fairly planning opportunity for your A team, but it's also a real danger to your estate. Another one is annuities. Now, if you put $100,000 into an annuity and that goes up to $1.1 million, when you die, your beneficiary gets $100,000, doesn't pay income tax on that, pays income tax on the $1 million gain. So that's just pure income. And that is, again, a really big, a really big tax hit. And there are a lot of things that you can do to mitigate that tax bill or spread it out over time. So very important. Failure to proactively plan for future legislative changes. That's important because one of the things we use in many plans in our firm is something called a trust protector. A trust protector is somebody who has power over the trust, but is not the trustee, meaning the trust protector can look at a trust, everyone gets together, the A team gets together, and they say, wow, the law changed. We really need to change this and to an or this 5 to a 3. And if we can do that, we're going to save a lot of tax. Trust protector can do that without having to go to court, without having to go to probate court. And that is a really good thing to have in an estate plan. We have a whole webinar on what is a trust protector. And if this is all new to you, I would really encourage you to take a look at it. Overlooking Internal Revenue Code Section 1035, exchange opportunity, not 1031, 1035. That's if you have an old life insurance policy and this life insurance policy is not as healthy as a new one would be. What I mean by that is sometimes the fees, let me back up. Over time, there's been fee compression, meaning institutions are charging less and less and less and less. A life insurance contract has fees as part of the contract. If you took out a contract, 20 years ago, the fees are higher than if you took out a contract this year. This is how it is. So sometimes it makes sense to take that existing life policy and do a tax deferred exchange into a new life policy, because you oftentimes, you would only do it if it benefits you, but many times that can be guaranteed past age 100 to 105. And we had one instance where a client had about a $600,000 death benefit with a $60,000 cash value. They were paying $6,000 a year in premium payments. We were able, working with their certified financial advisor, to do a tax deferred exchange, buy a new policy with the same death benefit, but no premium payment. So it saved the client $6,000 a year, which is kind of half a trip to Hawaii, I guess, because everything's gone up. Business owners utilizing only pre-tax 401k deferrals. Business owners, you can do cash balance pension plan. There are a lot of other things you can do out there to really juice up. Instead of putting away $50,000 or so a year, you might be able to put away $300,000 a year. So there are great planning opportunities out there. But again, these are things that the A team talks about. Estate planning and administration, improper titling of assets. That is probably the biggest thing that makes estate plans go off the rails is assets are not titled in the name of the trust. You got to go back to probate court to deal with that. Failing to keep your plan updated, changes in the law, changes in your situation, right? Births, deaths, divorce. Maybe your son married that girl. You don't really like her. I don't know, whatever. But changes in your estate plan. Failure to get a step up in basis on property at death. So what I mean by that is if you have a legacy B trust, there's like the A, B trust, So if you have this legacy B trust and assets are in that B trust, many times you don't get the benefit of being able to sell that property in the B trust when the surviving spouse dies, free of capital gains tax. And that would be, or maybe joint tenancy property, you do not get a full step up in basis. So we cover that in a lot of other webinars. Unnecessary loss of Prop 13 protections. People blow this. They blow it all the time. They blow it all the time, especially if you have property in an LLC. There are a lot of rules out there that hardly anybody knows about. Okay. Real estate people don't know about them. Estate planning attorneys, I'm sad to say, that is one area that estate planning attorneys, they are getting better at because the parent to child reassessment exclusion went away with Prop 19. But I'm telling you, this unnecessary loss of Prop 13 protection, we see it a lot. People lose it because they make a mistake. So don't be that person. All right, so look at some case studies here. We have Abel. These are actually real cases in our firm that we've had in the past. So we got Abel here. Abel is a beneficiary of a trust, and Big Bank is the successor trustee. Now, Big Bank, I'm not going to name the bank. Big Bank is the investment manager and the investment advisor, right? And the trustee. They sell proprietary funds to Big Bank as trustee. So they're making money as trustee. They're making money on their proprietary funds, and they're charging an overlay management fee on top of that. So they're getting fee on fee on fee. The tax advice in this particular case was coming out of a firm in New York who really didn't know much about California taxation. And that was a question that was presented earlier. If it's an out-of-state person, should you have somebody who's local? Yeah, I mean, especially in California. You know, if you own property in California, if you own real estate in California, and you hire a lawyer who is not familiar with California's property tax system, that can cause your property to get reassessed, right? They can do something that may cause the property to get reassessed while you're alive, okay? And you obviously don't want that. Expensive proprietary investments, we mentioned that if Big Bank is selling their own Big Bank investments to Big Bank as trustee of this trust, of Abel's trust. And so what solution did we do? Well, we modified Abel's outdated irrevocable trust documents. So there were some problems in there, and we fixed those. We brought in a California CPA who understood the state-specific nuances, and the financial advisor that in this particular case, this account was moved from Big Bank to a trust company that's very different, and we cover that in some other webinars. Implemented a tax-efficient investment portfolio using ETFs and individual stocks as opposed to the proprietary funds. Now, something that you need to know is if you had a mutual fund in 2022, it's possible that the mutual fund went down. It's actually very common. The value of the mutual fund went down. So what you had at the beginning of the year was less than at the end of the year, and you still got a tax bill. The reason is when the market goes down, many times people take their money out of the mutual fund, and the mutual fund has to sell stocks, right? Individual stocks to pay for the withdrawal. That may trigger a capital gain, even though the value of your mutual fund went down. And so that a lot of people got stuck with capital gains tax bills on the mutual funds. Anonymous asks, can you edit an irrevocable trust document? Yeah, so let me give you the California's rule on that. If everyone's alive, you can modify a trust with agreement of all the parties, the trustees and the beneficiaries. And if one person is dead in that mix, typically the grantor is the one who dies, you do have to get court approval of that. But yeah, you can change it. So another East Coast big bank unfamiliar with the client. This is Baker's solution. An East Coast big bank unfamiliar with the client and her needs, who lives in California, right? This was interesting. One institution was acting as trustee, the fiduciary, the investment manager, and the advisor on everything. So it was kind of the fox watching the hen house. Imagine your trustee is also your investment advisor selling proprietary investments from their parent company, right? And over 50% of this portfolio was in non-transferable investments, meaning some of these proprietary funds, if you fire Big Bank and want to go to trust company, for example, you can't take those investments with you. They say, they're not transferable. So it's a way to kind of have some, I wouldn't call them golden handcuffs. I would probably call them iron handcuffs because they're not good. But it's a way to keep people at a bank. So you have to be very careful who you choose. If you're a wealthy individual and you're creating a plan and you're naming a corporate trustee, bank or trust company, you need to be very careful who you choose, okay? So what did we do? We updated the beneficiaries appropriately to ensure what the client wanted. She had the power to do that on an irrevocable trust. It's called a power of appointment, best described as a power to disappoint, meaning you can give somebody something in a trust and then you die, and that person can say when that person dies, they get to decide who gets the property. We assembled a great A team: estate planning attorney, third-party corporate trustee, certified financial planner, institutional asset manager. It's a fairly large estate, and a CPA. We rebalanced the portfolio into a tax-efficient, low-cost portfolio, got rid of the proprietary investments. And in 1 year, we saved the client $300,000 in income tax. And this is because, we saved $300,000 a year in annually between trustee and investment management fees. So this is where fees come in. Now, this was a very large estate, but $300,000 is a lot of money, all right? And sometimes you're not going to see what the charges are, right? Very hard to find it. So if you're the beneficiary of a big trust or you have a lot of assets, you really need to pay attention to this, because if you're going to name an institution as a trustee, you really need transparency on fees, and you really need to nail them down on like, what's the process and are you disclosing all of this? And so we were able to save this particular client $300,000 a year, which always blows me away. Strategy number 3, this would be the high W-2 earner. This is going to be somebody who's got, large portion of their comps RSUs, and this leads into obviously an overconcentration and embedded capital gains in one stock. And so, if the stock's up, you're feeling good. And if that stock comes down, and a lot have, right, especially a lot of tech stocks, you're not feeling so good. In this case, the client was in their mid-50s and facing large RMDs in the future. What do I mean by that? Well, the client had a very large retirement account, IRA 401k. We knew this thing would grow. And when they're 75 or earlier, that thing's going to be really big. And every dollar they take out is going to be taxed. By the way, your minimum distribution when you hit 75 is almost 4%, in the threes. If you have $10 million, that's $400,000 if it's 4%. A lot of money, okay? And remember, the law is the rule of 72. Money doubles every 7.2 years if there's a 10% rate of return, and it doubles every 10 years if it's a 7.2% rate of return. So if you're in your 50s and you're not going to take that money out until you're in your 70s, that may double 3 times. And that's where I'm getting this crazy high number. If you have $1.5 million in your 401k at age 55, that could be almost $10 million, right? That's a big number. So again, over 50% of the assets in proprietary non-transferable investments, which is bad. So here's what we did. We revised their living trust and got that squared away. And that's really important. Part of this is taking a look at your estate planning documents. We accelerated the taxation on a one-time $1 million Roth conversion. And so what we did is we also utilized a charitable strategy to offset the taxes on the conversion. So this is where CPA, financial advisor, and lawyer come in, and we all figured this out together. And we implemented a charitable strategy to sell the appreciated RSUs tax-free and fund a life insurance trust for future estate taxes. So if you're not even following this, that's okay. But if you have a lot of RSUs and you're worried about death taxes and you're worried about taxes when you retire, this is why you need an A team. And these are pretty complex examples, but the point is, look, this is important stuff. And if you go, wow, that's me, it may be appropriate for you to get your A team together. Now, this is an A team in action. This is not our A team. I just couldn't resist when I was doing prep for this, because I loved that show when I was a kid. I used to watch it with my dad. So we're talking about the A team on the left, not the A team on the right. And that is the A team. So how does a multifamily office work? What is a multifamily office? Okay. This is part of the A team strategy. So at our firm, Cunningham Legal, our family office is the engine that gets important stuff done. You just think about that. It can coordinate your A team, and oftentimes does, holds other people accountable. So somebody is appointed as the person to, herd the cats, for lack of a better term. So our multifamily, there are a lot of different, by the way, a single family office is a wealthy person. They say, hey, I'm going to hire a financial advisor, lawyer, CPA. They're going to work for me, just for me. Bill Gates has a family office, right? He's a gajillionaire. Some people, I would say single family office, you're probably 100 million and over. And if you're 10 million and to 100 million, I would take a look at this. I mean, I think that's really the on the kind of the bottom end. Otherwise, there's really not much value that can be added. But the multifamily office is where you have multiple families in one office, if you will. And that's one of the service offerings that our firm offers. And this council is about tax mitigation quarterly and annually. So we look at it quarterly in California because Californians pay taxes quarterly. It's measured quarterly and annually federally, and objective financial counsel, but not financial services. So Jim, I'm looking at this. Is this, I'm looking at buying this building. Here's the cash flow analysis. Does this make sense, right? Does this fit into my overall plan? Should I be doing something else? How should I finance that? I'm talking to this person and this person says that, and that person says that. Maybe we could look at my other assets and see if there's a way to optimize the structure. And then philanthropic foundation and compliance. Many of our clients are very philanthropic. They do give to charity. They do give back. And frankly, if you're a rich person and you're not giving back, you should. So that's my belief personally. But, if you're not that kind of person, I guess maybe it's not a good match. But we do like clients who are philanthropic. There are a lot of people out there in real need. And if you've been blessed with, material wealth, it makes sense to share it. Ongoing risk management, really important. What do I mean by that? Well, if you have real estate, should it be in an LLC or not? Should those LLC shares be in some type of asset protection vehicle or not? That's what we're talking about, risk management. And we're also we're the agent for service of process in California for our clients. That removes your name, your personal name, from being served with a lawsuit. So no one wants to be served with a lawsuit, but if we get served with a lawsuit at a law firm, we can accept service, so they're not knocking on your house, right? Your home. So how does a family office work? Our work leads up to an annual family summit. And at the annual family summit, that's a meeting once a year, we have insight and planning to ensure synergy between all your advisors. All the advisors come to the meeting, and it consists of our team internally is a partner, associate attorney, paralegal, and administrative assistant that is assigned to your family office. And we're working on that, frankly, throughout the year, depending on the level of involvement. Some people we're more involved with, others less involved. It just sort of depends. The type of services that we offer: tax planning. So it's, somebody says, hey, I'm going to have a liquidity event. I'm going to have 5 million in income, and it's going to happen in the third quarter. What can I do to mitigate my taxes? Okay. Well, it depends. You should talk to us in advance, before the deal's done, before the deal's structured, because there are oftentimes many things you can do to get tremendous tax benefit. Financial planning. Now, we're not directing investments, but we do make recommendations in conjunction with your financial advisor on directions. And this is kind of to maximize overall wealth. Like, yeah, it would be a good time to talk to your financial advisor right now. Or you say, well, my financial advisor recommended this. Okay, well, let me talk to that person and see see what's going on, because a lot of this stuff's very technical. I happen to be insurance and securities licensed, so I understand this more than the average bear. I'm not giving advice, but I understand it. And so it's really good to talk to the financial advisor and just there's a level of comfort there. Legacy planning, obviously, it's one of our core service offerings: wills, trusts, and other vehicles for generating multi-generational wealth. And we oversee old plans. So many of our clients, they come to us, they say, Grandma and Grandpa passed away, and there was this trust that my parents had, and now I have, and what do I do? And this seems all kind of complicated. And this thing was written in 1948. What's going on? We get a lot of that coming in. Business planning, business succession planning, and creation and maintenance of entities, LLCs, partnerships, and other corporate structures. That is part of the family office offering, and there's kind of ongoing issues that come up with those periodically. Charitable planning strategies, primarily, these are strategies to reduce or defer taxes, and education and financial governance. This is really helping with the family mission and purpose statement. A family mission statement is, hey, this is kind of what we're going to be doing for the next 5 years. A family purpose statement really doesn't change. And, an example of a family purpose statement is, we've been blessed with material wealth. We don't want to spoil our kids and our descendants. We want people to have a work ethic. We want people to be humble. We want people to be caring toward other people. That is the reason our family exists, and that's why we're doing this. That's an example of a purpose statement. And a mission statement might be, hey, we're going to weather this storm. whatever it is in this business thing for the next 3 or 4 years. So that's a little bit more, mission statement's a little more tactical. And then we house kind of all the documents in a secure environment. And that's really, really important. You know, there's so much. I was watching something on AI last night, and you got to be really careful with this. If you get a phone call and it sounds like, you know, your kid, it might not be your kid. It might be an AI scammer. This is happening now. So my voice is on here. You might get a call. You might get a call from me saying, "Hey, it's Jim Cunningham," but really it's an AI hacker. Who knows? But kind of scary. And they're targeting typically older people. So it's because older people have more money. So what's a multifamily office family summit? This is a once a year. We get together typically late summer, early fall, and we have a high level agenda. And again, the family mission and purpose statement. And then we kind of go through the entities and, hey, has anything changed? Some clients many times will say, oh yeah, well, that property was sold and we did this and we refinanced that. And that typically happens on the prep, but sometimes happens at the meeting. We have a comprehensive up-to-date net worth statement. We do track basis, all these little things that are very, very important. And your corporate structure, a diagram. Many of our clients have simple corporate structure. Others have fairly complex, and a game plan for tax mitigation. And so that's why we kind of have that toward the end of the year. You kind of know what your income is going to be for that year. You kind of know what's going on, what's on the horizon. And then we can have a plan for either paying the taxes, right, or mitigating the taxes. And really, the family office, the multifamily office, coordinates the efforts of the A team, and really we're the client advocate, right? The lawyers. We're making sure whatever your it is getting done. And I will tell you, professionals frequently drop the ball. Guilty as charged. I've dropped the ball before. It happens. I will tell you, because I'm human, right? That's why we have other people in the organization say, "Hey, Jim, you know, you were supposed to do this last week." Oh, thank you. But we have a process in place, right? I will tell you, it's the same with other advisors. And sometimes it's hard to think of solutions for clients when the client's really not materially participating, but it's our job to figure that out. And so, you know, if you say, wow, that sounds really cool, I've got people who are working for me on my side, figuring out how to meet my goals without me having to drive it, this may be for you. So when the lawyer shows up to the party, we like to say people get it done. So the lawyer's looking over the shoulders. And I will say engaging law is kind of this weird thing. We have to have a written fee agreement pretty much on everything. And engaging a law firm is typically a series of one-offs. The annual family office agreement is an annual agreement. So you say, hey, can you work on this? Can you work on that? Can you work on that? Yes. But it's a continuous engagement is where I'm going with that, rather than a series of one-offs, which can get kind of clunky. That is the end of our material here. We got some questions, and we do have offices in Northern California, in Auburn and Montclair Village, not Montclair, California, which is in the Oakland Hills, which is just east of Oakland, Sacramento, San Francisco, San Rafael, Walnut Creek, Pasadena, and Westlake Village. Subscribe to our YouTube channel if you're watching this. And we have our next webinar next week is investing in a slow growth economy. So there's a link in the description and a link in the chat. It's going to be a good one. And Christina Lindsay Orta, who is a certified financial planner with Ascent Wealth Management, will be joining me, and we'll be covering a real hot topic, right? So I know a lot of people are worried about their investments right now. I am, right? I'm thinking about it. If you're watching this on YouTube, you should keep watching because it's going to roll to another video.